What's the topic of discussion?
The reason why I'm making this video is very straightforward. I've seen this question go unaddressed in the comment sections of too many influential YouTubers' videos, and it really needs to be answered. I'm a strong advocate for index funds and ETFs, as the body of evidence supporting them is so strong if the funds are left to compound.
Hey, leave the dollars there.
The two products are very similar, though they are not the same.
Some little differences.
Both are investment vehicles designed to track an index by holding shares in each of the companies that make up that index. For example, the fund would hold shares in each of the companies making up the S&P 500. The advantage here is obvious. You can invest in a fund such as the classic VFIAX for Vanguard in the US for as little as $3,000, which would gain you exposure to the entirety of the S&P 500, so you've quickly and cheaply achieved diversification.
Rest assured, your money is safe.
Whereas a single share in Amazon would cost you more than $3,000, let alone a share in Berkshire Hathaway, which would cost you nearly $500,000 at the moment. So what's going on here?
It's simple.
They both have a lot of the same benefits. They are low fee, low maintenance, diversified, and liquid. Although they each hold similar baskets of securities if they are tracking the same index, an ETF is effectively more like an equity investment than a fund, as an ETF is listed on an exchange and traded like a company. There are 5 main points to be aware of. 1. Fees. 2. Automatic reinvestment of dividends and distributions. 3. Tax treatment. 4. Liquidity. And 5. Differences in the language. Fees are always something to check as they sneak up on you. Because units in a fund are bought directly from the fund manager themselves, there are typically lower fees or no fees involved with your investment. Whereas buying shares in an ETF will require the payment of the brokerage fee applied by whatever platform you trade through. Funds typically offer automatic reinvestment with no additional fees in doing so.
All too easy.
Where not all ETFs offer this. Where this isn't offered, you will need to log in and make those trades for additional shares, attracting whatever brokerage fee the platform you trade with is applying. Of course, the tax implications of both these investment vehicles depends on what country and or state you're in, as tax laws differ and there is an ability to invest in these through tax-advantaged accounts, like 401ks and IRAs, as well as other equivalents in other jurisdictions which you really need to start looking at.
Simples.
Fortunately, both vehicles are very tax efficient when compared to actively managed funds because there is far less work to do by the fund manager. They are not researching shares or executing an investment strategy, they're just mimicking an index. There is one main point of distinction between the two. When shares in an ETF are sold, they are sold at the price set by the market. The seller receives directly this price from the buyer and the fund is not involved. However, where a unit holder in a fund wishes to realize their investments and withdraw the money, the fund must sell down shares in the underlying holdings to be able to afford the meeting of that payment, which means the funds will experience a capital gain or loss. This does have implications for each fund holder indirectly, even if they have no intention to sell. There is also a small point of difference with liquidity.
So pay attention.
Because shares in an ETF are bought and sold like stocks on an exchange, you're able to buy or sell them at any time during the trading window for the exchange you're trading on. Withdrawing your investment in a fund, however, is only cleared at the end of the trading day or other period specified by the fund you're trading with. This is largely irrelevant for long-term investors, however, so you shouldn't really be too concerned.
Just kidding, but not really.
One other point, which is unlikely to occur but can, is that both do have potential stalls on liquidity, in that shares can enter a trading halt where for a period of time you will be unable to trade in shares. Additionally, funds do sometimes have the contractual rights to freeze withdrawals to protect the underlying investments of the group. So make sure you're reading these terms carefully and that you're comfortable with that risk. There are also differences in the language used for each vehicle.
Please forgive me, it is a second language.
The payments you receive from an ETF are typically described as dividends, where they are called distributions for a fund. Additionally, ownership in ETF is through holding of shares, as opposed to units in a fund. The key thing to remember here is that both are suitable investment vehicles for investors looking for long-term holds.
Key is persistence. Keep at it and never lose your cool. Oh, come on, you stupid...
If you enjoyed this video, please hit like and subscribe and comment below.